indivisible, with liberty and justice for all.
We don't have invocation on, but God bless America. Amen. Roll call.
Mr. Vaughn, here. Mike Tranter's here. And Mark, so, yes, here, and Joe Ross is here.
Okay. I move approval of the agenda.
Second.
Roll call.
Aye. Aye. Aye.
I move into approval of minutes, regular minutes, June 8th, 2022.
No objection, second?
Okay. New business, meter investment overview. Hey, Nick, you're up.
Oh, all right.
So I have you on the big screen so everybody can see you. So,
Okay.
and I made copies of all your presentations, so I don't know if you want to share your screen or if, I mean, everybody can just follow along with the top of the packet.
Sure, yeah. If
Whatever.
anyone wants to follow along, that might be easier.
Okay.
Just to going this route. First and foremost, hello everyone. Sorry I can't be there today. But little one had surgery today, so keeping me back here in Columbus. But I'm glad I can join you.
Okay, Nick, you're up.
Oh, all right. Well,
So I have you on the big screen so everybody can see you. So,
okay, perfect.
and I
Well,
made copies of all your presentations, so I don't know if you want to share your screen or if, I mean, everybody can just follow along with the packet.
Sure, yeah. If everyone wants
Whatever.
to follow along, that might be easier. Just
Okay.
going this route. First and foremost, hello everyone. Sorry I can't be there today. I have a little one had surgery today, so it's keeping me back here in Columbus. But I'm glad I can join you this evening. From a time standpoint, how long do I have? I want to be courteous of everyone's time today, obviously knowing that you have other issues.
I was hoping if you could cover it in like 10 to 15 minutes, if you could.
Oh, yeah, you got it.
right.
So it's not, everyone sounds like they probably have some inflation fatigue, which that's where we're going to be going with a little bit of this discussion today. It's definitely out there in the news. It's been a big pillar of the last, call it 12 months or so. I know we feel it in our own personal pocketbooks. We're feeling it even at our own municipality levels. I'm sure you're feeling it on that front too. And it's definitely a catalyst and the big driver of obviously the Fed having to change its stance and movement of interest rates. I think for the sake of time today, I do want to talk 1,000-foot view of what we're seeing in the marketplace and just changes from a year ago. I think that's really important. And then ultimately diving into the portfolio, and I can take questions. But first and foremost, any questions or anything directly on the economic side of things that we might want some clarity on? Okay, no worries. We'll just dive in here. Ultimately to page 3, and when we're looking at the Fed's evolving rate plans. So, I think this slide is very, very telling of how quickly the rate environment has shifted in a very short time. And I think historically speaking, even when you go back and look, coming out of the 2008, 2009 financial crisis, the Fed was very adamant that they were going to be a little more methodical in their approach, where they were going to be raising rates, wait and see what happens. Let's raise rates and wait and see what happens. But ultimately, as we fast forward here and we get into March of 2020, the Fed cuts interest rates to zero on a Sunday to prepare for the COVID pandemic. And then coming out of that pandemic, ultimately we're probably very familiar with the dot plots that the Fed publish here. And this is just a representation when you're looking at the measure from August of 2022. From March of 2021, the projection going out there across that curve was that interest rates were going to be remaining in that zero interest rate environment for a time period. The Fed was going to be very accommodative in their stance. And ultimately, as you continue to progress at each individual Fed meeting, the rate of in the path of interest rates moved very, very quickly. Where that term, you continue to hear the Fed use very much over time, was that inflation was transitory, was where persistent came into play. And obviously with that became their forecasting that interest rates were going to be moving higher. To ultimately, we've seen some unprecedented rate increases. It's over 300 basis points here currently this year. And we've had 3 75 basis point rate hikes. We haven't seen that in a long time, dating back in the history, and even a 50 basis point rate hike. So some very drastic moves from the Fed to move interest rates here moving forward to, again, combat inflation. And ultimately, from the most recent reading here in September, is that the expectation is that the terminal rate will be right around 4.6% into 2023. And then you can start to see the prediction is that the rates are actually going to go lower out when you get into years 23, 20, or excuse me, into 24 and into 2025 and beyond. And we're going to look at some of the economic data here that supports that. So from again, 1,000-foot view, yes, it is expected that the Fed is going to continue to raise interest rates to get to this, again, what's projected around 4.6% to be their of value to do. And ultimately, can you guys hear me okay? It looks like I'm getting an internet connection issue. Hello, can everyone hear me?
I hear you loud and clear. Nick.
Okay, perfect. So ultimately for us, yes, we think interest rates are going higher. Ultimately, in the longer run, the projections are that things will be going lower out longer. So with that said, I'll pause for a second. Any questions around that?
No.
Okay, perfect. So getting into the summary of economic projections there on page 4. So this is looking at a few key economic indicators that are published from the Fed. And we won't go into each of these in great detail here, but ultimately what this measures is, so it looks at from June of 2022 to December 31st of 2022. And it would be the same thing for September 22nd, so most recently, to December 31st of 2022. And a lot of these, you can see how quickly things have changed from these indications, specifically around just overall growth within the overall economy. When you look at, the strong dollar, you look at other global factors, just overall growth here domestically, there's a lot of challenges continuing to be presented, and it is expected that we look to see growth lower. And ultimately, we saw that in September coming in at 0.2% compared to where it was projected as of 1.7% in June. So a pretty quick, a big change from a growth standpoint, of a relatively short time frame. And ultimately, those predictions are continuing to be forecasted into the yield curve. And then in addition to that, you look at core PCE, which is the measure that the Fed looks at currently, and that's excluding food and energy. And there's CPI and PCE. You hear those terms broadly looked at, but core PCE being the measure that the Fed is monitoring, expected to come in around 4.5%. But in the long run, as you continue to move out into years 23 and into 2024, ultimately the participants are believing that by raising interest rates, that we ultimately will see inflation start to lower and get back closer to their target of around the average of roughly 2% over the long term. And with that, you look at the Fed funds rate, and then we see that ultimately over that 3-month time period from June to September, by the end of the year, it was a 100 basis point move between those 3 months of what's projected. And as we looked at into 2023, expected to go closer to that 250 to 2.75 range. But then obviously there's some recessionary talks creeping into the picture with the inversion of the yield curve and economic slowdown. Looks like rearing its head. And we're going to talk about how we're hedging in the portfolio in the event that we do see rates go lower. But it's not expected that we ever see rates, I shouldn't say ever, but we wouldn't see rates go back down to zero. But we do expect them to go lower and get us closer to where we were pre-pandemic. Again, given that inflation stabilizes and the employment picture remains stable throughout these points in time. Any questions there?
Nope.
Okay, great. We'll if it's okay, just again for the sake of time, we'll move past the labor market side of things, but ultimately the labor market remains tight. Ultimately, it's causing rises in wages from that standpoint. And ultimately, the Fed continues to see their policy stance to be fine given the strength of the overall labor market. And then we've touched on inflation, ultimately inflation here, and where we've seen these elevated prices from on a month over month standpoint of over 8% currently. So again, very strong, and we feel inflation across the board here. But I think the biggest thing is, let's take a peek at the yield curve, because the yield curve ultimately reflects the Fed's guidance on faster pace of rate hikes. So the market's pricing in these moves ahead of the Fed meeting and making these decisions. And ultimately, the shape of the yield curve has flattened. And we're seeing that due to a variety of different factors, whether it's an increased risk of recession or global slowdown, or what's going on between Russia and Ukraine. All of these factors are contributing to longer term outlook or growth being lowered, therefore yields being lowered. And with that, you ultimately are seeing, a recessionary signal of the inversion of the 2- and 10-year treasury. And so ultimately, what that ultimately means is, again, just short-term rates are higher in some cases than longer-term rates. And that's historically speaking has been a negative signal to the market, where there's been some type of recession or correction from those points. It's typically around like an average of a little over 300 plus days, which would ultimately take us into 2023 when the first inversion took place on the ultimate yield curve. But ultimately, from the standpoint of the township, the fact that we do have inflation and we are seeing elevated rates, from a fixed income standpoint, that leads to higher income back to the township. And so ultimately, we'll talk about, you can see strategy here, we'll talk about that in relatively short term. But in 2021, with some uncertainty surrounding the markets and the Fed's rate path, our strategy from an overall structure standpoint, when you jump to page 9, when we look at the overall maturity distribution, we were really working hard to build out what we would call a stable or strategic ladder, with trying to get our maturity distributions pretty even across the board until we got more clarity from the Fed. So ultimately, I thought this would be just a case for us to look at, where we're looking at, okay, here, from a security standpoint, we're at 8.1 million, a little over 8.1 million. The overall weighted average yield of the portfolio was coming in at a 1.22%. And then ultimately you can see the maturity distribution there. Again, not exactly even, but it takes time to get there. But ultimately, with the thought in mind that we wanted to get more clarity and again, direction the what the Fed was looking to do because there was some uncertainty there. So from there, we've evolved to ultimately get us to where we're at as of 9/30, where we've ultimately have seen the overall portfolio yield jump up to a 1.46% from a 1.22%, with estimated annualized interest income jumping up to over 120,000 in annualized interest income. And ultimately, from a maturity distribution standpoint, we are working to be heavier in those 0 to call it 3-year buckets on the fact that, yes, we believe interest rates are moving higher. However, we do want to start hedging and locking in some of these higher yields out years 4 and 5, based upon some of these economic projections that we're seeing that rates could be lower in the future. So we want to hold on to these yields for as long as we can, even in some cases where they're lower than shorter term rates. So with that being said, for us, we're going to start having some continued maturities into that 0 to 1 year bucket over the next, call it 6 months, that are going to be going in at these rates that are above, 4+%. And Kim's and I have been working. She's gracious enough. She sent over her cash balances over the last 12 months. And we were looking at bank balances to ultimately try and determine how much additional cash we can look to put into the portfolio and take advantage of these elevated rates that we haven't seen for over a decade. And, the determination is going to be anywhere between 2 to 4 million that we think of additional cash that we could put to work, which is really going to drive up your annualized interest income when you compare that to other other options in the marketplace that are permissible under your policy and ultimately Ohio Revised Code. So I think I went over my 10 minutes. I got a little long-winded. I apologize, but any questions?
No, this is only what we have currently. So we've talked about moving to him, but we haven't told us yet.
Oh, I'm sorry. I couldn't catch that.
He was asking that 2 to 3 months we were talking about last month. He was asking if it was included on the sheets that you gave us, and I told him no, it wasn't.
I'm sorry, Kim. I can't hear you.
Sorry.
That's okay.
Can you hear me now?
I can, yes.
I was
No
facing
problem.
behind the computer.
That's okay.
So what I was telling them is he wanted to know if the 2 to 3 million that we had talked about in September, if it was included in the sheets that you gave me. And I told him no, that was something the board would have to decide, to move over at some point in time.
Yes, ma'am. That's correct. Yeah, we weren't acting on that. Kim was just doing, I guess, more legwork and back end and prepared for this conversation that we were going to be having today. Yep. And typically what we do, just so the group knows, is that we went back historically and looked at those ending cash balances to ultimately determine where the low point was for the township. And from there, carving out, saying, okay, well, we look at the entirety of the investment portfolio, we look at the entirety of cash that we have, and where's that low point? And then taking 80% from that low point and investing it and keeping that remaining 20% liquid so we have backup liquidity built in.
Okay.
Yep. And we can get very, creative in how we want to do this too. So in the event that the team there would like to say, hey, we want to put more money to work, but we want to keep things shorter in nature just because we could have some projects on the horizon. That's 100% an option. We would go at your discretion on what you want to see. If you're like, hey, go ahead and take it to what your model is telling you, we can operate under that standpoint. I mean, to give you an idea, 9-month commercial paper now is around 5%. So you're seeing some very nice elevated short-term options that can be nice buffers in the portfolio on that side of things.
Okay. Well, given the fact that it takes forever to get anything anymore, that would be a good investment. 'Cause
Yeah,
every time we buy something, it's usually 9 months to 15 months to be before we get it.
yeah, from a maturity standpoint, and that's
Right.
it's the one thing about the interest rate environment in the fixed income world. And this is another thing that we are doing is analyzing in the event that we can sell a security and get out of some of these yields that are not attractive. But ultimately, we don't want the losses to exceed any of the income that we could have where we realize a loss on the books, unless that would be something you would want to see. For our governmental clients, we typically wouldn't recommend that, especially as an entity of your size. I don't think it would be something you would want to do. But again, that's something we can talk about if we do want to explore that.
Okay.
Yep. But the name of the game here is that let's take advantage of these rates when we can. Let's lock in to yields, preserve this interest income so we can stabilize our budgetary flows into the future here.
Okay. And then I guess all the rest of the pages are just showing like where you guys have our money invested.
Yeah. So that would be on pages 9 and 10. So this just gets into a breakdown of the maturity distribution across the different maturity buckets. And as I mentioned, when you look on page 10, if you really focus in on that 0 to 3 year space, we are trying to build up our 0 to 2 year buckets and really our 4 and 5 year to give us some hedge that if rates do go lower, we want to lock into these yields again, so we can preserve these higher rates that we haven't seen in some time.
Okay.
Yep.
Did you guys have any questions for Zach? Okay. I think everybody likes it today.
Okay, cool. Awesome. Well, good, Kim. Well, Kim, I'll just work with you here. I'll let you internally discuss what's being talked about, and we can talk about getting the additional funds or the dollar amount moved into the US bank account, and we can get those invested.
Okay.
Great.
Sounds good. I can put something on my board's agenda.
Okay.
Discuss that.
Sure. Absolutely. And, happy to help as always if anything pops up.
Okay.
Awesome. Thanks,
Thanks,
everyone.
Megan.
Appreciate the time. Absolutely.
All right.
Take care.
See ya.
Bye-bye.
I just have one follow-up question. Trustee, what are we going to do? Are we going to earmark this, the interest money to go towards something?
I think that's something that we need to talk about. We haven't, this is the first I'm hearing about it, so, we have to have discussions.
I mean, if we put another 2 to 3 million in this, it's probably going to net somewhere in the neighborhood of $150,000 next year. And, we're talking about some kind of administration building or addition or whatever that is, and I don't know what that dollar amount's gonna be, but, this is like a Christmas club. We can set aside the money and just have it grow towards it, maybe as a down payment or something. So anyway, I was curious as to what your thoughts were on where we would put that money. Or earmark.
And I can't remember whose idea it was to do the meter. I know it wasn't mine.
You do what?
I know, I'm just trying to do a little
I know, I just got the local school district to go.
But at the same time, they have some annual income coming in that amount with the meter. And they can save part of the money. Frankly, with the downturn economy and having rates go higher benefits the government, or our government, I should say, better. Not necessarily the individual. I think that was a great choice to do that.
Also, I like the fact the way he's designed this, he's trying to front load some of the money in 2 and 3 years, taking advantage of projections for the higher interest rates, knowing it's going to go come down eventually.
I mean, an annual income of $120,000 pays for at least one other police officer or sheriff, or maybe a sheriff and a half, if you wanted to put it towards law enforcement.
So, if we move this money over, it is tied up to the years, right? Just by nature of the investment.
Could be.
That would be interest you receive during the year.
I understand that, I'm talking about to
The principal.
It could be.
It would be spread out
Yeah.
over the same time frame as the 8 million you have now spread. In those percents that he's got on page 10, it's probably gonna be the same way in the future years, although he's probably gonna change the percent a little bit higher moving forward as the interest rates go down.
But I think what I heard him say, Phil, is you can get commercial paper right now at a 5% yield. So at a 9-month.
9 months.
So you move the money in there, you buy the commercial paper for a 9-month period, and at the end of 9 months, you're gonna see your 5% return. So that'll get you some short-term.
And I think the
Cash.
village and the state money in that is stabilized more than when it was maybe 5 to 10 years ago with the elimination of the estate tax, the local government fund, things that were sort of a siren out there when we were losing money from the state. Now you have millage and things that are coming in more regularly, so it's stabilized. So, I mean, I think your concern would be if something changes more and you need to access that money.
Well, it's coming out of the checking account.
Right.
So, the last balance as of October 4th was 9.4 in the checking. So if we take 3 out of that and we're at 6.4, is that fine in any way? Or? That's my only question.
What biggies do we have coming up? Of course, we don't even know if we can get them.
Well, we're gonna pay for the play set, and then we've got the building coming up, like the service garage, and then, let's see, we gotta pay for the other dump truck that we have on order, the street sweeper that we have on order.
So let's talk about the meat house.
Yeah, and the meat house, we gotta figure out what to do with that.
Do you have anything else on the meter investments? Any other questions on that?
Nope.
Should we move on to the budget?
Sure. Do you want me to go ahead and answer all of Rick's questions?
Sounds good to me.
Okay. So he asked about miscellaneous non-operating, the 1,892, it's a revenue account. Those are always a crapshoot. We just never know what we're gonna get. I know I printed the paper from January to October, and in that 892 account, we've gotten like $18,000. So the largest chunk of that was $10,000 from the recycling incentive. And then we usually get a $3,000 donation for the yoga. So, but the recycling incentive changes every year. Sometimes we get 20,000, sometimes we get 16,000. This year we only got 10,000, so it keeps getting lower and lower and lower and lower. So that's why I just budgeted 10. I always like to budget a little bit lower than normal and then hope for the best. You just never know. But I can change it, doesn't matter to me either way. On the appropriation side, the 1,110,229, that's other employee care. The reason it went up so much is because we switched our deductible for our health insurance. So we used to be a 3,000, 6,000, and then we went to a 5,000, 10,000. So we increased our reimbursement for our HRA from 4,000 to 8,000. So that's why that number went up. Now we have to completely budget for the full amount every year by law. We have to budget for it, so I can't change that number, but that's why it went up. Now we don't always spend that. So I did include a sheet in the packet that you can see on this, the 229. You can see what we've spent for the year. We've spent like, I budgeted 28,000, we spent 23 to date. So, and that's between our, EAP that we have to pay for and then our HRA. So, and it, like you said, you just never know what, right, who's gonna get sick and when, or who's gonna go to the doctor and when. It's just, it's always different. Under the 311, that's also the same. I put 70 in there because you just never know what lawsuits we're gonna have or what legal stuff we're gonna encounter. This year we've spent 40,000 to date. Now I only have legal bills up and through August, so I still don't have a legal bill for September, October, or November. So, and if you add all those numbers together, it's about an average of $5,000 a month. So I'm gonna need another $15,000 just to get through the end of the year. And you can tell I don't have enough money. So I only have $9,200 left over in my purchase order that I have, but I still have $15,000 left in that appropriation. I just have to close out this one purchase order and open another purchase order to get us through the end of the year. But like I said, you just never know where legal is gonna be. I mean, we try like heck to, you know, not use Jeff as much as we can, but, you know, yeah, it's just, we've had a lot of stuff pop up this year. On the improvements to sites, the 300,000, that is the playground set. So we ordered a playground set for 7 Gables, and it cost $538,000. So we're going to take $200,000 from the general fund, and then the other $100,000 that I have in there is I have plugged in $35,000 for the Montgomery Road medians, $50,000 for parking lot repaving, and $15,000 for the MSD sewer extension costs, because MSD is gonna run a sewer extension from Industrial Drive down to right after our lot where our wooded trees are, right across from our administration building. So we have to pay for part of those extension costs. So that is what that $300,000 number is.
Who we're using for the playground structure? Who's the vendor?
We bought from Landscape Structures. They're out of Minnesota. So that's what that number is. On the motor vehicles, that would be my car. So it's truck 210. It's a 2014. It's got about 135,000 miles on it. So by the time, if we ordered something in January, we probably won't get it till August or September of next year. So by that, what's that?
You going electric?
We don't have any way
We
of,
haven't even talked about that.
yeah.
Yeah, we gotta talk about it.
I mean, that'd be something they would have to decide. We'd have to completely install electric charging stations and everything. So, and then buy batteries when the batteries go bad. So anyway, so that's what that is. And then operating supplies, fuel for 2191. That is the police department's fund budget. So we budgeted this year, we budgeted 30. So as of the end of September, I still have $12,000 left in that appropriation. However, I have not gotten a regular bill for fuel since July. So we have called World Fuel, we have called Likens Energy and bugged the crap out of them for our bills, and we've gotten none. So I've only gotten 1 bill for July, 2 bills for August, and 1 for September, and I know that's not, because usually they're making a weekly stop here. So it could be that I don't even have enough money appropriated, the 30,000. So that's why I upped it to 50. I have no idea. We call them and bug them. Like, cause I hate to wait till the end of the year to resolve all this stuff. So I have Bill call them all the time. I'm like, we need the bill. We need to pay these bills.
Is there any recourse by them not giving you the bill that you just say, I'm gonna pay you this and say that's it?
No, because then they'll send me the bills next year and then we'll have to, you know what I'm saying? Cause I've had that happen before.
Okay.
So anyway, I budgeted 50,000 just in case, and a lot of it, if you notice, I know the price of regular gas has gone down, but the price of diesel continues to increase, and most of our vehicles are diesel vehicles. So we are getting 0 breaks on any kind of fuel costs. I mean, we get a little bit of, I don't think we have to pay federal taxes. We have to pay a little bit of state taxes, I believe, but we don't get that much of a break as far as, and obviously, I mean, we spend more in the wintertime than we do in the well, it's kind of cyclical. We spend a lot in the winter, spend a lot in the summer, and it just kind of goes down in the fall and in the spring. So that's why I did 50 on that. And then as far as operating, the operating supplies in 2196, I could probably lower that one. So right now, I budgeted 30, and I think I've only got purchase orders open for about 20. So we could lower it down to like 25, if that makes you happy. And then, let's see, payment to another government. This is where we have to do the TIF payment to the schools next year. So we have to make a payment to Loveland Schools and then make a payment to Sycamore, but I have no idea how much we're gonna owe them. I've asked both of the treasurers to do the calculations for me because I don't know what their millage is. So, and I have not seen those numbers.
Does this have any relationship to that lawsuit?
It does. We ultimately prevailed in that lawsuit, but this would be an extension. So last year, we, at the very end of the year, the board voted to increase the TIF, like extend it for another 15-year period. But the law says that if we do an extension after 1994, that we have to compensate the schools for their portion that they would have gotten. So we entered into a tax agreement with Loveland's schools and Sycamore schools to do that, but I have no idea what that payment will be. It's whatever their millage is.
Payment by?
It's when we get our collection, which is usually like in April-ish, May-ish, as soon as we get that collection, then we have to make that payment. So it'll be twice a year. And then we get it again in August-ish, September-ish.
So the 580.88 is an estimate,
It's an estimate, yeah.
and is that split 50/50?
No, Sycamore schools would get less than Loveland schools because Loveland has more acreage in their TIF part than Sycamore.
It's acreage, not people.
Right. Yep.
So if you had to guesstimate how much Loveland would get, what do you think it is?
It's probably like a 85-15 split. Because I think Sycamore only has like 4 acres and Loveland has like 20-something acres.
And they know about it.
Yeah. Mm-hmm.
So. Well, it's not included in their budget for next year.
Well, that's because they don't know how much it's going to be either.
Well, but they could guesstimate as well.
Well, the problem is if you look back on what we have received in the past, it's been such a varied amount. It's really hard to budget for. Because one year we got like 800-something thousand, the next year we got 755, and then we went back up to 800-something thousand. So, and a lot of it had to do with the sale of the property at the time.
Okay. They didn't disclose this.
Well, I know that they're just now doing their budget for next year.
It's done. But it's not in here.
Okay.
And they didn't disclose anything.
Well, maybe they're working on it. I don't know.
Okay. They're working on the tax increases before.
Okay, so then I don't have an update for the new administration building options. I think we're gonna do the tour. We'll set that up for our February meeting and talk about that in February. And then the parks levy stuff that I mentioned. I gave you a list of, what this is this sheet is for my purposes. This doesn't mean anything to anybody else but me. It's just ideas that usually if one of the board members
What sheet are you
says,
looking at?
oh, it says Parks Department on the top of it. So it's
Oh,
this
okay.
big sheet and it says Parks.
Yep, got it.
So this is my way of keeping track of what ideas have been thrown out there and like pie in the sky stuff. So if, like we know we need to replace the play equipment in Seven Gables in 2023, and then we're gonna do, We're hoping to do Shady at some point in time in 2025 and maybe Hopewell Meadows in 2027. And then this also helps me keep track of, you know, like trail improvements and whatever it is. This is my list. So the problem is everything, because the costs have gone up so much this year just because of contracted services and everything else, it's getting harder and harder for us to budget money for projects. So, and it doesn't have to, nobody can agree with me, but I'm just saying if we don't do something in the future, we will run out of money to be able to do these nice projects that we want to do, and I just hate to do that. So I would suggest maybe in the future, maybe we say we're going to put $225,000 in a project every year, and then we just budget, I don't know, whatever millage that would be, if it's 0.2 or 0.25 or whatever it is. Maybe see if people want that. Do they want us to continue to put these projects in the park? And if so, this is how much it's going to cost.
When does the Home of the Brave run out? Isn't that, are we done with that one, or is that still going?
Now that goes till 2037.
That's what I thought. I knew it was long term.
Yeah, it was a 30-year note.
And we can't use that specifically for these others.
Nope, Home of the Brave can only be spent for Home of the Brave.
Can we do a reduction if we don't need all that for that amount of time, and then try to reallocate it, like with a new levy, and say that'll be a reduction? Are we allowed to do that in some way?
I was gonna say, we use quite a bit of it. Those bonds are like almost $500,000,
Yeah.
like. Let's see, 2172. Yeah, so we bring in 518,000 plus 53, so 571.
And at least a few of these are Home of the Brave. I see 3, 4, 5.
Yeah, and we'll
7,
budget
8,
those out of Home of the Brave.
9. Yeah.
As many as we can. But the biggest takeaway is we only bring in 571,000 and the bond is 474 that we have to pay. So you see a large majority of that goes to the bond. And then whatever we have left over is we're paying for like contracted services there, and then we're paying for electricity and cameras and, you know, stuff to operate it.
Anybody else have any questions on these things?
I had a general question, and you guys might talk about it later in the meeting, but the mead house, I know in the proposed project budget for 2023, it mentions 150,000 from the general fund and then the other coming out of the parks fund. But in this general budget here, it looks like all 300 is coming out of general.
Yeah, I have it both ways, just in case.
We just don't know what's happening.
Yeah, I just don't know. We're going to have a long discussion about the meat house because originally we thought the basement was only going to cost us about $100,000.
Okay.
And now the contractor's telling us it's probably going to be triple that. And just because they don't agree with the other structural engineers' analysis of it, they thought they could come in and just replace the beams. And our other guy that we hired to actually do the work, he's saying that he would take the beams in a totally different direction and reroute this and do this. And then, of course, when you do that work in the basement, it causes structural damage upstairs because all of those walls are plaster. So when you torque the building, it's going to torque the plaster and it's going to break the windows. And then you have money upstairs that you have to spend to fix all the things that happened because you fixed the basement.
We don't know.
Yeah, so they're going to have to discuss that at another meeting and make up their mind on that. It may just go to zero. I don't know.
That's what it sounded like earlier, but I just wanted to double check, so thanks.
We might want to put that on the agenda for February.
I think you guys wanted to talk about it before that, right?
But I mean, just to revisit, see.
Okay.
Yeah. Any other questions? Should we move on? Anything on the 4-year 2023? We go on to old business budget 2022.
I put together the very last page of all those sheets that I have, they're my budget sheets. So this is just a project list of 2022 and when we completed it. And you can see there's, a couple things that are still on order. So biggest things being the purchase of the tractor with the sidearm mower. That is on order. We still haven't seen it yet. We're hoping to get it by the end of the year. The other thing, the street sweeper, they had to, I guess the company that makes the street sweeper is at Elgin. They only made, the dealer in this area only got 4. And we were not lucky enough to be one of the 4 people that got their street sweeper this year. So now we're going to have to be on the list for next year.
Are we locked in on the cost?
Yes, we're locked in on the cost, but we lucked out on, or didn't luck out, but they just didn't have enough to go around, so we got pushed to 2023.
But they can't come and renegotiate or come out?
No, because we already signed a contract with them. And then the large dump truck chassis, we had ordered a second one because it took us 2 years to get the first one. So we went ahead and ordered another one thinking it was probably going to be another 2 years. So we'll probably get that in 2023 as well. Let's see. Replace the doors on the restrooms at Symmes. I believe all the parts are on order still, and they were supposed to hopefully come in this month. And that project hopefully will be done by the end of October, because all it is once they get all the doors, they just need to be painted. And then we already have all the electric done to put the electronic strike in. And then it just is a matter of it getting painted and the doors getting installed. Let's see, still waiting on, we talked about the mead house. Playground equipment's on order. We think it's probably going to come in about March of 2023 and hopefully be installed in the spring. And then we will have to order the turf when the playground equipment comes in. It takes about 4 to 6 weeks to get the turf. So we're going to have some areas that are going to be that poured rubber play surface, and then other areas that are going to be that green, like shawl grass turf.
Where are you getting the turf from?
It's a company that Landscape Structures deals with. I don't know the name of the company, but they partner with them, and they don't need to order it won't take as long to be on order as the playground equipment, because it's it's specialty ordered and tailored to you.
Field turf like football teams.
It's kind of similar, but it's like, I have an example of it back in the office. It's like a plastic. It's plastic and sand. And it's like a turf, like an artificial turf that goes over top. But it's probably not as nice as a field, but it's close to it. So then we've got a couple engineering things going on. So we've gotten a complaint at Mead along the south property line that our water is going on to the houses that back up to that. So we're kind of looking at engineering, like what we can do to help that situation. We're still working on the repairs to the Remington Fire Station. They were supposed to be working on that this month because they got 6 beams on one side and beams on the other side. So that's like, we have to kind of do it in stages, because we have to shut the back down and then finish the back and then move to the front so that the fire trucks can, enter and exit the building whichever way we're not working. Let's see. And then a couple other engineering projects. So we've got working on sidewalks on Snyder from Kemper to Hamiltonian, the bridge vandal fence designs and drawings. Those are pretty much done, but we just have a couple more things that we have to do to turn in for the Hopewell Bridge. That's in 2024. We've got Terwilliger's Court storm pipe replacement project, and then the Timberlake storm. So that's why I left those 2 on the project page. I left those 2 blank and the Mead one blank, because I have no idea what the cost is going to be for any of those drainage projects. So when I know a good number, I'll plug that number in. And then I also forgot about the mid-block pedestrian crosswalks. So those are supposed to be in. We ordered those back in July or August. So they're due in this month. So those will get installed this month, hopefully, fingers crossed, at those different locations that are on the list. So that's all I got for that.
have a question about fire
Yep.
trucks.
Okay. We got the expert sitting in the room.
Do we have one that is gonna have to be replaced soon?
Yes, that's why I came this evening to bring you up to date on what is very grim information that's in the industry. Right now, we're seeing about a 3.5 to 3.8% increase shortage. And the prices have escalated dramatically on top of that. Not to mention the fact that the manufacturers are telling us you'll not get a fire truck for 2 years. So if you want a fire truck 2 years from now, you better order it now. And the one thing I'll be asking the trustees to consider for next year is to place the order for the fire truck next year. We won't get it for 2 years. Same way.
Pay for it in 2 years.
Yeah, the city has a ladder truck that is being replaced. If we buy them at the same time, we get about a 10% discount for that. But also, we lock in now, we don't have to pay now. We lock in now, and then we won't have to pay for that until the apparatus is delivered. Rather it's an ambulance, either way the ambulance, because we have next year in the budget, we have an ambulance in the budget. But we're not gonna get that ambulance for a year and a half to 2 years, even with order the next year. But my concern is I want the trustees to be able to lock in that price so that we're not paying, when you talk about a $700,000 or $800,000 fire truck or $1.2 million ladder truck, 10% is a big dollar. So we need to try to lock that in as soon as we can for those. And the other thing that I'm recommending, especially since the fact that we're able to get more money on our investments than we've ever had in the past, that the trustees might want to consider putting those on leases versus paying cash for them. The nice thing about the lease, in the last 3 vehicles we did on a lease with the city, we did it through a leasing company because they are tax exempt leases. So they're able to sell them, but we don't have to pay the bond counsel for that and issuing bonds versus a lease versus doing a bond. So there's a big savings in that if you were considering doing a bond. But doing the leases, the last one we did were about 2.8 to 3%, because they were tax-free leases that we did for that. And then you can do those leases over 5 years, you can do them over 10 years, or whatever. Keep your money invested at the 5% that you're getting, and then turn around. And so if that goes down 3 years from now, and you decide, well, we have the cash, let's go ahead and pay off the lease. It's $1 buyout at the end, and there's no penalty for selling or turning in the lease early for that. So there's a lot of advantages right now for the trustees to make a decision next year to move forward with that. Because every month that we wait, or every quarter that we wait, we're getting a significant increase in cost.
They require down payment on the trucks.
They do not. They do not.
So do you need both a ladder truck and a fire truck?
The ladder truck is from the city, and that's being replaced in the city. Out of their
But
funds.
what do you need, a ladder truck or a fire truck?
Here in the township,
Yes.
it's a fire truck.
So you need to do a fire truck, and you would want to have a lease, would be more advantageous.
I believe the lease would be more advantageous because it would allow you to keep your money invested now that you're trying to do now. You might pay, 3 or 4% on an interest rate on that lease. But like I said, when 2 or 3 years from now, if the market goes down and you're not making as much money on your investments, you can go ahead and pay the lease.
If you bought it, it would be for a fire truck, $700,000 or $800,000.
Correct.
What's a lease run?
Well, depending on how many years you want to do it. The last engine we did a lease on in the city cost us about $60,000 a year. And so we did that over a 10-year period in the city. And the nice thing about it too is it allows you to keep your cash on hand and stretch out your legs. And that's, to me, that's a big thing being able to do that. So next year we have the ambulance budgeting, and I'm going to recommend to the trustees we do the same thing. We purchase the ambulance on a lease, whether it's a 5-year. Because now the township buys ambulances that are large enough that can last us 15 years instead of 8 years. So we went to a much heavier duty, heavier chassis, lower maintenance costs, and they last a lot.
What's the lifetime of a fire truck?
Fire truck company
not recommend the trustees invest in anything electric. That technology is not there yet. And we just came back from New York, where we went to school for 3 days on all of these electric problems. And the problems are very significant. They're not, the American public doesn't realize the problems of lithium-ion batteries today. It's a very significant problem. Yes, yes. The house burned down in Loveland 6 months ago from lithium-ion batteries, and the garage plugged in from the DeWalt battery.
All the cars in Florida that are catching fire because they got flooded. It takes them 2 hours to put the car out.
And the reason that I'm asking the trustees to do this with the engine next year versus right now, because I put in for a federal Fire Act grant to pay for the engine. I don't know, and I won't know until probably the end of November if we get that. If we get that grant, or the federal grant to pay for it, we've been very successful this year on our grants. We've done over about $500,000 in grants this year. So we'll wait till that grant period is over, and we'll know whether we get rejected on that or not. It's kind of a 50-50 toss-up in the rest of fire trucks, or kind of a wealthy community compared to communities out in the boonies who really need it. So that's kind of where we're at, and I'll be working with the township administrator to try to get this information that we'll push forward so that we can.
Is that, like, I have 325 plugged in for the ambulance and 650 plugged in for the engine? Are those good numbers, or?
I mean, we're seeing, they're changing so drastically.
Okay.
The engine numbers I got this week from both manufacturers were, the engine's probably closer to about 780. The ambulance is probably going to be closer to 390. You know, so we have those big numbers and they have jumps up 3 and 4%. It's
Okay, and then do they have the option to pay for the chassis when it comes in?
They do have that option, and you get
Okay.
the savings.
All right, because I'd rather do that, because then you're not out, then you're not paying $1.2 million in 2024. You could cut it, you know, budget appropriately, like you budget maybe the cost of the chassis in 2023 and the cost of the ambulance, like the truck itself in 2023, and then you budget the remainder in those other years.
Yeah, if you're going to pay cash, that's certainly.
Okay, so then it's up to them whether they want to pay cash, or if they want to lease, then obviously, do they know the percentage rate on the leases?
We don't know yet.
Okay.
I'm sure that changes, you know, like what's going on with the market changes all the time. So that's probably something that we would also want to lock in,
Okay,
lock that lease in with those. And then if we lock the lease in, we could actually then pay the manufacturer the down payment and get the 5 or 7% they offer as a savings for paying for that up front. Because what happens, they pay for the engine and the chassis and all of that up front, so they don't carry that note on that.
okay.
What do you think is the buyout after the lease?
It's zero. It's a dollar thing.
It's a purchase?
Yes, it's zero. We own it. You're just basically paying for a tax-free note
Oh.
up
Okay.
front. So yeah, no.
Yeah, you can do it for 3 or 5 years, right?
Yeah, you own it at the end.
Okay. That makes.
Yeah.
missed
Why would
that.
But
anybody
you
ever
still-
buy something then?
Well, but you still have to pay that interest
I
rate.
get it, but
Yeah.
still, okay.
A lot of companies are looking to flip their leases. Just because of what's going on with inflation and what's going on with, they don't know what's gonna happen next year.
I really just have had a lot of success with the leases. Only the thing I like is it stretches out the levies. Yeah, it might cost us. And before, when we weren't making any money on our investments, you know, you're still paying that, but, you know, now you're making money off your investments. And it looks like that might be the case for the next 3 years. anyway.
Any other questions on that? Anything else on the committee meeting for tonight?
I just had a question about that outlot house. What's going on with that?
We bought it, we closed on it in August, so now we're working on getting all the water, the sewer, and the electric shut off.
What did we spend on it?
It was $96,000 the appraisal came back at.
Include the car.
I finally got the title to the car, so I just need to contact a company to come and haul it away. But they won't take the car unless you give them the title. So I had to work with the owner to give me the title.
donate it?
What's that?
You donate it?
Yes.
They can donate it without a title.
True, but I have the title, so I can just give it to the wrecking company or whatever it is. So our plan is, as soon as we get all the utilities shut off in the next couple weeks, I have to take out a demolition permit.
Maybe an exercise or practice run, we get towards the house in the car, and you guys can get some practice.
I have to get a demolition permit, and then as soon as I get that, we can tear down the house, and then we'll have all the trees cut down, and then we'll just level it for now, and then plant grass, and then figure out, like, you know, when we start having these admin building discussions, we'll figure out where everything's gonna go.
It had always been the township's thought of purchasing that back when this campus started. We just could not get those people to